Hello, namaste, and a very good evening, everyone. A very warm welcome to today's session of Equity Market Insight by UTI Mutual Fund. I'm Sonal Mittal, Product Specialist at UTI. Over the next 1 hour, we will explore the evolving global macro environment, India's relative positioning, equity valuations and earnings outlook, the investment strategy of UTI Large Cap Fund, and then we'll take up your questions. To help us understand current market environment, I'm pleased to be joined by our MD and CEO, Mr. Vetri Subramaniam, who will share his perspectives on global and domestic markets and their implications for investors. Later in the session, Mr. Karthik Raj Lakshmanan, Fund Manager of UTI Large Cap Fund, will take us through the investment philosophy and portfolio positioning of UTI Large Cap Fund. So let's get started and invite Mr. Subramaniam to begin with the questions. Welcome to the webinar, Vetri.
Good evening, everybody. Thank you, Sonal. Delighted to be here again on this edition of the monthly market insight for equity. It's already February 2026. It's been a very eventful month already in terms of the news flow. But as I always say, it's the job of news to be present every day, every month. Whereas the task for investors is to remain focused on their financial goals and not worry so much about the daily news flow. But with that out of the way, let's get rolling. I think Sonal has put together a large number of slides today, so there are more than the usual number. So we'll try and cover it as soon as possible. And then, of course, we've also got Karthik joining us on this call, who will be talking about UTI Large Cap Fund. So over to you, Sonal. We can get the ball rolling today.
Sure, very well said, Vetri. Let me begin with the global backdrop. One of the biggest macro themes globally has been rising debt. How should investors interpret rising debt levels, and what is the implications for government finances?
Sure. Yeah, so I think we can take a look at some of the slides that we have on that. And what you will notice over here is that if you look at the period prior to 2007, actually the most significant expansion in terms of debt happens with households and also with the non-financial corporates and financial corporates. The contribution of the government to debt, even though it grows, is not the most significant. However, by the time you get to 2025 from 2007, what you will see is that it is the government which actually makes an outsized jump. Even as households remain steady, financial corporates deleverage and non-financial corporates see some slight increase in leverage. So really what has happened is that in the period after the global financial crisis, which is post 2008, the job of taking up leverage in the economy, or rather the baton, has passed into the hands of government, and it is the government which has been racking up debt or increasing its debt. All of this in an attempt to actually support growth or to try and revive growth. So this is a very big difference in terms of what is driving the debt, particularly over the last 17, 18 years as compared to the period prior to that, where it was more the corporates and households who were driving the incremental debt. If you look at the next slide, this also will provide you with an insight into what is happening in terms of the debt burden of governments. When the debt burden of government goes up, effectively their interest payments go up. And if you can see the chart on the right-hand side, what you'll see in that chart is effectively how much is the interest payment as a percentage of GDP. And you can see that for pretty much all the economies over here, there is a significant explosion in government debt interest payments as a percentage of GDP. One of the most dramatic increases is actually for France, but most developed economies over there have a significant increase. So effectively, they not only have more debt, but also because inflation has been more volatile, interest rates have been higher, and as a result of that combination of higher debt, and higher inflation causing higher interest rates, their aggregate debt payment obligations in terms of interest has gone up. Now, when a government has to pay more and more by way of interest cost in its budget, effectively that means they have less fiscal headroom. This is something that I was mentioning even in the context of the Indian budget, where we were talking about the fiscal discipline, but more about that later. But Sonal, to your question, I think as far as the developed markets are concerned, this is the challenge. They have increased the government debt too much, and therefore interest payments are eating into their financial flexibility.
Sure. So we have a tighter fiscal space and still evolving inflation dynamics globally, bringing this closer to market performance. Emerging markets have outperformed US over the last year, and US dollar has softened. Is EM outperformance largely a weak dollar story?
Good question, Sonal. I know it's very convenient to talk about correlations, but it is always important to remember that correlation is what we observe, but correlation is not causation. Market outcomes are not determined by a single variable. Yes, if you look at it historically, there is a correlation between a strong dollar and weak emerging market performance. And similarly, there is a reasonable correlation between a weak dollar and stronger EM performance. Without doubt, in the last 1 year, EM relative performance has been strong. That is correlated with the weak dollar. On an inverse scale, you can see that on the right-hand side chart. But I would only caution one thing to everybody watching this. Do not draw a straight line between one variable and the other. There are multiple variables that determine market outcomes. So we cannot only rely on the likely strength or weakness of the dollar to determine how markets will behave. As with everything else, it is multiple variables which impact the outcomes, and crucial among them will always be earnings growth and valuations.
That's interesting, Vetri, because currency is often seen as a performance driver, but growth and earnings ultimately determine sustainability. Now, shifting focus to India, we have recently seen important trade developments with both EU and the US. How meaningful are these trade agreements in your view? Can they structurally improve India's export competitiveness and growth trajectory?
So Sonal, I think it's important to step back and understand the kind of world that we live in today. For many years, I would say going back to the 1990s, we first had the General Agreement on Trade and Tariffs, followed by the WTO. Now, what GATT and WTO did is they created a set of rules by which major countries govern their trade and tariff policy, and as a result, everybody did their best to keep their trade policy largely compliant with GATT rules or later on with the WTO rules. But we have effectively seen a breakdown of this multilateral system of trade, which has persisted for almost 30 years. And as a result of that, it is now becoming more and more important to have bilateral deals between large economies. India has, of course, been doing a lot of these. We did an agreement with Australia, with New Zealand, with the EFTA, which is a group of European nations. We have also done one with the UAE. And of course, this deal with the EU is quite significant. It's significant for the simple reason that the EU is actually India's single largest trading partner. So that makes this deal very, very important. Now, if you look at the share of European imports from India on the right-hand side, you'll see that it is very, very low. Whereas the share of European imports from China is very high. Now, obviously, as a result of this trade agreement between between India and Europe, there will be an advantage for Indian exporters that they will hopefully be able to take advantage of. And I do think in some of the sectors, Indian exporters will be able to seize this advantage and they will be able to grow. But at the same time, remember the benefit of a free trading of a free trade agreement actually accrues to competent companies or competent exporters in both geographies. So I would also submit that certainly there will be benefits to some of the European, economic constituents, be it companies or exporters, who may now be able to export to India more competitively than before. But I think that is in India's interest to create these bilateral agreements where we can have a preferential system, and that is what this deal offers. And because this is India's single largest trading partner, I think this is a very major milestone. It also reflects a change in thought process with India, and full credit to the government for getting this executed. This has been in the works and discussion for almost 20 years, but full credit that we were able to get this executed. We can also look at the next slide. I think this talks about the India-US trade deal. I would just say two things over here as far as this US-India trade deal is concerned. One, remember when the reciprocal tariffs were announced, and when the subsequent additional tariff, because we were buying Russian crude, was announced, what we said is that, look, the actual Indian exports to the US are quite limited, at least in terms of the tariffs, or rather the goods which are subject to tariffs. So the negative impact on the economy will not be too high. Now that we have moved from a situation where there is a disagreement with the US, we have managed to move that to the side. We have reached some sort of agreement with the US. The tariff disadvantage is no longer as significant as it used to be. But as you can see on the left-hand side, we are sitting somewhere in the middle, and all the competitor economies, or at least some of them, are 1-2% this side, that side. So I would say there is no relative disadvantage with peers, but it is not like we have reached a particularly advantageous trade transaction. But the important thing is, given the US economy's disproportionate size, given the fact that they are the dominant global superpower when it comes to policy issues, including defense and foreign affairs, and given the fact that they are such a major digital power, it was very important for India to be able to put this disagreement to the side. So I think just being able to move this disagreement to the side, to my opinion, would really be a positive development for India. How much it will actually result in incremental growth or in terms of incremental benefit to the economy, we will have to see. Effectively, the agreement moves the tariffs back to where we were in April 2025 when the reciprocal tariffs were announced. So in a way, I would say it is a decent outcome in what was a relatively tough situation. And we have moved away from being in a stalemate situation. That is the good news.
Sure. So hoping these trade agreements form a structural trade tailwind for India. So now let's look at the domestic policy support. Recent Union budget for FY27 maintained capex while gradually consolidating the fiscal deficit. Do you think the peak drag from fiscal tightening is behind us? And how supportive is the current fiscal stance for growth?
Absolutely right on that question, Sonal. I think that's very visible when you look at this chart on the left-hand side. You can see what the government is trying to do in terms of continuing to reduce its fiscal deficit over time. The left-hand side just shows you two possible trajectories of the fiscal glide path based on whether the economy grows at 10% or 11% in nominal terms. But the crucial thing is that, if the economy grows at 11% in nominal GDP terms, the reduction in fiscal room for the economy is only about 0.5% over a 5-year period. Compare that to the previous 5-year period. In 2021, the year of the pandemic, our fiscal deficit was at 9.5%, and then this year we brought it down to 4.4%. So that was a 5% compression of fiscal deficit. Now, of course, we are talking about a 0.5% to at best 1% compression of fiscal deficit over the next 5-year period. So what was a drag, what felt like trying to drive with the brake pressed down, now the brake is not depressed as strongly as it was placed earlier. So when you are reducing the fiscal deficit, it is like trying to drive with your one foot pressed on the brake. But now the pressure will not be applied as significantly as it was before, and therefore the drag reduces. And I think that is good from a growth point of view, and also speaks volumes about the fact that India has done an excellent job of coming back to this path of fiscal discipline. If we just move on to the next slide, we can also see something else from the budget, Sonal, which is to say that, of course, there was a significant markup in capital expenditure as a percentage of total expenditure of Government of India. Actually, you can see this if you look at the last two yellow bars on the left-hand side chart. Look at the middle part, which is the yellow bars. Look at the last two bars and look at it from FY21, how that bar accelerates into FY25. So that was the 4-year period where Government of India really raised its capital expenditure as a percentage of its total expenditure very significantly. But that, to my mind, is now behind us. But the good news, despite all the chatter, is that Government of India is continuing to do a good job in terms of quality of spending, because it is maintaining at a stable level the level of capex within the structure of its total capex. And on the right side, what you can also see is that there is some incipient recovery from the worst part of state capex as a percentage of GDP from the pandemic year of 2020. So I think the quality of spending as far as capex is concerned of Government of India, big rise for 5 years and now showing stability. It's a good thing.
Very well. If the fiscal and trade dynamics are supportive, the next key variable becomes earnings. Betty, how does Indian corporate performance compare to other major regions? And what has been the performance of different market segments in India?
Correct. So, Sonal, I think the point that I would make, and most people know this, I've heard more people ask about international investing in the last 1 year than I have in the past. I would always submit that international investing should be a portfolio allocation decision rather than an attempt to figure out which geography will do the best, because that is like the same search of, can I own the best performing stock? Can I own the best performing fund? Or for that matter, can I own the best performing asset class, which in the last 1 year has been gold and silver? We saw that in the SIP data. Suddenly, everybody only wants to buy gold and silver. The flows into gold and silver ETFs were more than the flows into equity products. So that should be the reason why you do international investing. But over here, what we are focusing on is, how does India's growth compare to that of other geographies? Broadly speaking, if you look at the left-hand side, we've looked at 2018 to 2024. What has been the trend in terms of corporate revenue growth over that 6-year period? This is ending CY24 for India. That will mean March 25. And we've looked at that data over that entire 6-year period. To simplify it, if we look at the median growth for Indian companies and Chinese companies, they're actually quite similar at 11.6% and 11.7%. In the case of India, 58% of the companies grew higher than 10%. In the case of China, 56% of the companies grew higher than 10%. As you can imagine, the developed world, which is US and Europe, median growth was much lower, 6.2% in the US, 6.6% in Europe. By the way, it's also interesting to see here that therefore the European growth has actually been higher than the US growth. And the percentage of companies with 6-year revenue growth higher than 10% is also slightly higher in Europe as compared to US. And maybe that's one reason why now in the last 2-3 years, Europe in US dollar terms has actually done better. It's a combination, as I said, of multiple things. All market outcomes are a combination of multiple things. And if you look at Europe's outcome, I would submit it's a function of cheap starting valuations, reasonable growth. As you can see in this data, it's actually doing slightly better than the US. And finally, the recent strength in the euro vis-a-vis the US dollar. So all of that is feeding into this data. From a valuation perspective, the question that you asked, Sonal, it's interesting. On the right-hand side, we've just compared the median trailing 12-month PE for Indian stocks. And, just as a benchmark, we've compared it to the 10-year GSEC yield. Broadly, you can see over this, 12-13-year period, the orange line, which is the 10-year GSEC yield, comes down from almost 8.5% now to about 650, 670. But if you look at the median trailing PE multiple, it goes up from almost 15. In the pandemic, it drops sharply back to that 15 level, but that climbs all the way up to 40. So median. So 50% of the companies are actually pricier than 40 in 2024. As of today, 50% of the companies are higher than 35 in terms of that trailing 12-month PE multiple. Now, you could argue that because rates have come down, there is some scope for PE multiples to move higher. But also keep in mind that when rates go lower, it's because of lower inflation. It also implies lower nominal growth, and that implies lower potential for earnings growth. So, it's hard to believe that just because of rates alone, we can justify this high level of valuations. Having said that, there has been some correction in valuations from the 2024 peak, but I think what you continue to see when you look at trailing 12-month Indian valuations, the median valuation of 35 times is still a slightly rich multiple. If we move on from that, Sonal, to the next slide, we can also see what impact this is having in terms of market performance. As you can see, on a one-year basis, the Nifty 100, the Nifty Midcap 150 are both at about 9% return. The small cap index is barely flat at 0.01%. On a two-year basis, again, the Nifty 100 is at a 9.6% return, and the Nifty 150 Midcap is at 10%. The small cap is much, much lower at merely a 3% return. And I would submit that some part of this is just explained by the starting valuations being much higher in the small cap 250. But be that as it may, we've been calling out the risk of small cap underperformance, and we are now seeing that relative to large caps on a market cap index basis. Now, individual stocks will always have very different patterns, but I'm approaching it purely from a top-down perspective. And, I think we are seeing the impact of those elevated valuations that we called out more than 2 years ago. Moving on to the next slide. This shows you the expectation in terms of earnings growth. There's been some movement in earnings growth expectations, both a cut in 26 as well as 27. As a result of that, we now expect, or rather the benchmark consensus for the Nifty 50 Bloomberg consensus estimate is only 5% earnings growth in March 26. So 2 years in a row where we are getting sub 5% earnings growth. This is expected to improve in 2027, but last time when we discussed that growth rate was expected to be almost 16-17%. Now it seems to have normalized to only 12% growth. And next year, 2028, we are now getting estimates for that as well. It's about a 13% growth. So I would say a 12-13% earnings growth expectation, not out of sync with the expectations of 10 to 11% nominal GDP growth for the Indian economy. I used to previously call this a high bar. I won't call it a high bar anymore. But neither would I say that this is a particularly easy number to reach for. Even in the last 2 years, remember when we've had nominal growth in the 8 to 9% range, earnings have actually been growing slower than that. So this is now a more reasonable ask as compared to the high ask that we had earlier. Finally, moving on to the next slide, this shows you NSE 500 companies with greater than 10% year-on-year growth. The blue line shows you revenue growth. The red line shows you profit growth. For the latest quarter, not all the results are out, but about 52% of the Nifty 500 companies who have delivered results are growing more than 10% year on year. And if you look at profit after tax growth, about 50% of the companies who have reported so far are growing more than 10% year on year. So that's what the current earning trajectory looks like. Slight improvement compared to 2 quarters ago, but still very weak as compared, or still much softer compared to where we were in 2024. Back to you, Sunil.
Sure. Where did naturally earnings expectations feed directly into valuations? As we are seeing valuations have corrected from peak levels, how would you characterize the current valuation environment? Fair, expensive, or reasonable relative to growth?
Sure. So we can look at the valuation slide, Sonal, and we'll just run through these. Nothing much has changed. Nifty 50 trailing PE essentially in the fair value zone in white. On the right hand side, Nifty 50 forward PE still looking expensive, but not that much, because at least in absolute terms, it is now trading at a 19 handle as compared to a 21 and 22 handle. On the next slide, you'll see the Nifty price to book. This is, of course, again in white territory, which is what we call the fairly valued territory, just slightly above the long-term average. The problem, Sonal, is on the next slide. This shows you the mid-cap valuations and the small-cap valuations. And as you can see, both these indices are still in the expensive territory. So in the small-cap space, despite negligible returns on a 2-year basis, these valuations are still in the red zone. In the mid-cap space, with little bit of the correction that we've seen now and some reasonable earnings growth, I must admit, in the mid-caps, that number is now still in the red zone, but it has come down sharply from its all-time high in terms of valuation. So this is as far as the individual indices are concerned, but we can also compare the aggregate valuations on the next slide in a more scientific calculation relative to bonds. And this basically compares the inverse of the Nifty 50 P ratio to the 10-year GSEC yield. I would say that this indicator is now in a more sort of neutral territory. When it is far away from that middle line, which is the long-term average yield difference of minus 0.94%. So when it is very far away from that, more like 2%, then bonds look more attractive. When this index spikes up into green territory, that is when equities look more attractive. You've now come closer to the midline, but not too close. So I would say there's not too much of a signal coming from this indicator. But on the next slide, we have our consolidated indicator, which is the UTI Equity Valuation Index. And this is a combination index because it looks at price to book, it looks at price to earnings, it looks at the trailing 12-month dividend yield, and finally, it also looks at the comparison vis-a-vis bonds. When this index is in that light yellow territory in the middle, that is what we call the fair value for equity investing. Today, this index is in the yellow zone. In fact, it's at the lower end of the yellow zone, and that is why we say it is actually in fair value. Investors can consider, allocating to equities in a staggered manner. When it is in the green zone, is a great time to increase equity allocation. What does this imply in terms of return and probability, Sonal? This is captured on the next slide, and you can see this on the next slide. Just go to the middle row, which is that yellow row. You can see that 37% of the time the market, on its history that we have captured over here, over nearly 20 plus years, essentially trades in fair value zone 37% of the time. The average 1-year return during that period is 12%. And there is a probability of greater than 50% that your return will be at least 12% or higher. Of course, the worst return which happened on a 1-year basis, despite buying in the yellow, was minus 31%. But only 18% of the time by buying in this zone do you end up with a negative return. So this is how we interpret the table. And that is why we say, this yellow zone is actually a reasonable zone to make staggered allocations to equity. So I think we can move on to the final slide just to sort of summarize some of the points that we talked about. I think the trade deal with US and Europe, it's a big sentiment positive. I should point out that the trade deal with US is actually still only an initial agreement. The actual conversation going back to February 2025 was about having a comprehensive trade framework. We have not reached that point as yet. All we have done is we have got rid of the impasse, which was there for almost the last 7 or 8 months. But with US, with Europe, certainly this is a remarkable trade deal. Will this immediately help India's growth? I would submit, just like when it was a negative, we said it will not hurt too much. Similarly, today, I would say it will not help too much. But in the medium to longer term, I think it means that India has now taken or started to follow a policy of more significant engagement with the rest of the world. And I think directionally, that is the right way that we want to go. And I would say this is sentimentally positive in the short term, but also good for the Indian economy in the medium to long term. Union budget has been balanced. We already talked about that. It tries to focus on growth while maintaining discipline. MPC, in recognition of that, has kept rates unchanged, maintained a neutral stance. We do see some scope for nominal growth acceleration in India from the current 8 to 9%, maybe to a 10.5% kind of level, as a result of all the policy support which is being given. The global environment still remains fairly volatile. Earnings growth will most probably do better than the last 2 years, which are low single digits in 27. But yeah, the current consensus growth in FY27, I won't say it's still a high bar, but certainly, 12-13% is not an easy number either. Our in-house equity valuation index we've already talked about. Remember, that only looks at large caps, and because of that, it's saying we are currently in the fair value for equity investing zone. We still think we are in an environment where investors should prioritize asset allocation and risk management. Yes, you can stagger your investments with a bias towards large cap because of valuations. And of course, from a style perspective, I must say it's been disappointing for the last 6 months to a year. We've been expecting some kind of a trend reversal in favor of quality growth. It seems to be getting delayed, but I would still say that the next cycle would be more favorable for quality growth as compared to value, simply because of the way the two cycles have behaved in the recent past. So I'll halt over there and hand it back to Sonal, and she'll then invite Karthik into the conversation.
Thank you, Vetri. That really sets the macro and market context very clearly. Let me now bring Karthik Raj into the conversation. Welcome, Karthik. Karthik, one common question investors ask is, large caps are limited to the top 100 companies and are widely tracked and researched. So where is the opportunity? Why should investors consider large caps?
Right. So that's often asked questions, but if we look at the key advantages that large caps have, the first one is that many of these companies are leaders in their categories. I mean, they're probably the number one or number two in their category by market share. And many of them have seen multiple cycles for decades, and their balance sheets are much more stronger. They've weathered the storm in the past, and to that extent, they're very familiar with the cycles. That also helps them. And the other advantages being the largest player or the second largest player in the sector, the scale that they bring definitely helps them in terms of controlling costs on various factors, both procurement costs as well as the operating costs, which itself helps them in better pricing or competitive pricing. So these are advantages which some of the mid-sized companies may also own, but the proportion is much larger in the top 100 companies or the large caps. If we move on, again, this is based on FY25. If we see on the left-hand side, the close to 70% of the revenues are still in the large cap category. If we take NSE 500 benchmark, which is largely the investable universe for the institutional investors, and profit-wise, also again, significant proportion is explained by the large caps. So same way on the right-hand side, if you see the chart, close to 69% of the market cap is large caps. Even as a percentage of GDP, that's the major share. The point being that any investor who's been in, or majority of the investors who's been invested in the markets for the last 1, 2, 3 decades, a significant portion of the wealth has been created in large caps because that's where the majority revenues, profits, and the market cap lies.
Sure. Thanks, Karthik. So if I connect this to your earlier point about competitive advantage and scale, could you walk us through a few examples where these structural strengths have helped companies gain market share or improve profitability over time?
Right. So if we take few examples, the point is clearly that sector after sector, the large companies over the last 1 or 2 decades have actually become larger. So that's where if you look at banks, the top 6 banks market share, which used to be about 48% odd a decade back, is almost 63% today. So the top six banks have actually gained share, while ideally we would believe that some of the mid-sized banks would grow faster than the top banks and they would gain market share, but the reverse has been true. The same way on the right-hand side, if we look at life insurance, again, the top six players annual premium equivalent has grown almost 1.5x the industry. I mean, if the industry has grown at close to 11%, the top six have grown at close to 14.7%. So that's where we are seeing the top companies in each sector growing faster than the industry. Even if we go to the subsequent slide, again, automobiles, again, the same story. The passenger vehicles, top four have continued to gain market share. The starting market share itself was quite strong, but they've kind of added to that as many of the smaller players have vacated or shrunk their market share. Pharmaceutical is pharma is one sector which is very fragmented, but even there we see the top 10 have somehow maintained market share. Some individual companies have actually gained, and clearly we are likely to move towards consolidation even in a fragmented sector like pharma. So the point is that in a country like India, where there are multiple complexities, or some of the CEOs, as they've called out, that there are many Indias, the large players who are present pan-India basis often have a significant advantage, and they are able to capitalize on that, which is visible in the market share gains.
Thanks, Karthik. That's insightful, especially the way you explained how these companies have grown over time and become profitable. So let me ask you this. When you look at UTI Large Cap Fund specifically, what makes your strategy distinct? What do you do differently in identifying and owning these businesses?
Right. The core of UTI Large Cap is the competitive franchise or moat. I mean, we look at the moat of the company in each sector within the top 100 companies or the large cap universe. And we do have some exposure outside the top 100 companies also, because the mandate requires we need to have 80% plus in the top 100, while we can still own some mid and small cap companies. The approach is similar for whichever market capitalization, large, mid, or small. Idea is to kind of identify companies which have some kind of moat which can be tangible, intangible. They may be like a brand, a distribution, multiple moats which help them create value much better than their competitors. So that's where their balance sheets are much better, their return ratios are better, and they score well on the overall the ROC parameters as well. So that's the key thing. If we look at the next slide, we are talking about the moats. So whether it is tangible moat or intangible moat, brands, I mean, in case of consumer companies, it is the brand which resonates with the consumer. The recall is what clearly helps them continue to hold on with the market share or even improve their market share. So that itself is a competitive advantage for the existing companies vis-a-vis new entrant kind of challenges these companies. Similarly, there can be patents which some of these companies own directly, or their parents internationally could bring in for them, which acts as a kind of a differentiator. Similarly, technology is something which is kind of a moat on the intangible side. Again, tangible is something that is clearly visible. I mean, we could have the lowest cost producer in some of the manufacturing sector, or in case of B2C businesses, the distribution itself acts as a moat, which is very difficult for a new entrant or a challenger to kind of break through. If we take a few examples to kind of drive the competitive advantage point, in case of private banks or in the banking space itself, the cost of funds is the biggest advantage for a bank. Because that's the raw material, and if the raw material itself is cheap, they're able to take lesser risk and still achieve their spreads. So they don't have to get into riskier lending. So that's where the cost of funds for, in this case, ICICI Bank being the example, we've seen that actually has helped it kind of control its overall credit costs and still deliver growth and profitability. On the right hand side, again, stainless steel, this is the single largest player, and they have a disproportionate market share and relationship with the end user customers. Many of them are B2B. Business to business, and to that extent, those relationship and the quality products that they're able to supply, besides the large capacity that they have, actually holds them in good stead compared to the cheaper imports, which are the real challenge in this case. There's some more examples, like, I mean, in terms of retailing, it is all cost, which is the key focus. And here we see in the value retailing, we have a company which is clearly focused on bringing down the cost of operations year after year. So that helps them kind of face the competition or gain when compared to many of the other competitors in the space without having to kind of increase prices. So it is the cost which they are trying to focus rather than on the pricing side. Again, telecom is one sector where we've seen huge competition, but the strong brand and the customer relationship and strong balance sheet has helped this company kind of tide through that challenging environment that we've seen in 2016-17 when the prices were almost dropped to zero. And from there, we've seen quite a few competitors have left, and the number of telecom operators has come down to just about 4. And there's been consolidation in the industry. And Bharti, who's been there with the right ingredients of brand relations and balance sheet, has continued to gain market share. So these are some of the examples from our portfolio where we've seen that the competitive advantage has helped these companies kind of do better in business, whether in terms of top line or costs or profits.
Sure, Karthik, that gives us a good understanding of your strategy and positioning within large caps. But investors today have multiple choices, especially after the strong run we had seen in mid and small caps. Why would you recommend large caps now over mid and small caps?
Yeah. So if we look at the rolling returns, whether it's 1 year or 3 years, we have 5-year data as well subsequently. The rolling returns clearly shows a similar trend where few years the mid and small caps outperform, and then you have few years when the large cap outperforms. The purple patch is the one where the large caps outperform, and the yellow one is where the mid and small caps outperform. So on the left hand side, we clearly see that in the last 1 year or so, large caps have already started to kind of outperform. We saw in Vetri's slide as well that on a 1 year basis, small cap is almost 0% return, while mid caps are just about in line with large caps. So we've already started to see that outperformance of large caps. While on a 3-year basis, still right from that 2021 post-COVID period, the mid caps have continued to outperform. So it's a matter of time if the cycle were to repeat again, the probability of large caps outperforming even on a 3-year basis kind of increases. Now, if we look at 5 years, again, the story is same. Whenever the gap between large caps and the mid and small caps is very high, there is a catch up that happens. So we saw a very large gap somewhere around 2024 end, and that's where subsequently the gap has started to narrow in the last year and a half. But still, there is some way to go as far as 5-year rolling returns are also concerned. So it's kind of the returning to mean, where I mean we've had a significant period of mid and small caps outperformance. We believe even valuations also reflect that large caps are slightly better than mid and small caps. Now, if we move to even on when you look at risk adjusted basis, while the average 5-year rolling returns large caps is around 12.6%, which scores lower than a 13.7 for small caps and 16.3 for mid caps. The point is that on a risk adjusted basis, the Sharpe ratios as they show, clearly large caps outperform the mid and small caps. In fact, small caps perform the worst in that. So that's where the risk adjusted returns still continue to be much better in large caps. The simpler way to understand is that at times of drawdown, large caps actually tend to outperform and kind of protect capital vis-a-vis mid or small caps. And again, one point that we've been highlighting for the last couple of years is that when you look at longer term growth, whether it's 1 year, 3 year, 5 year, the revenue growth, there's not too much of difference between large, mid, and small when you take the median. Averages can be misleading. That's where we've taken the median. And in that median, you see there's not too much to choose between large, mid, and small. What has happened in the last 4 or 5 years is clearly the profitability of mid and small caps from a very low point is increased. And that's where we've seen the profit growth of mid and small caps were far better. But eventually, the revenue growth has to do majority of the weightlifting. And to that extent, when you look at that number, there's not too much to choose between large, mid, and small. So even from that perspective, large caps score decently well compared to mid and small.
Sure, Karthik, that helps us understand why large caps may be relatively better positioned at this stage. For our audience, it would be useful if you could take us through your investment framework and give us a snapshot of how the portfolio looks today.
Right. So the framework is clearly the focus is on competitive franchises. And within that, it could be both on the growth or quality side or on the value side. And within the top 100 companies, we are happy to choose from both a growth company or even a value company, as long as it has a strong competitive advantage versus other players in the sector. So that is the blend approach that we have. And again, when we look at a stock or sector, the idea is both top down and bottom up. Large caps being clearly related with the economy, as we saw a significant portion of the revenue or market cap is from the large cap, so they are highly correlated with the economy. So both a top-down approach, at the same time bottom-up from a perspective of picking up the competitive franchises is what we choose to identify a stock or sector. And the risk limits, both internal as well as regulatory limits, continue. The top 10 stocks don't account for more than 55%. No individual stock more than 10%, and the sector weights not more than 12% over benchmark or absolute 40%. The portfolio turnover, since the focus is on franchises with strong moats, tends to be on the lower side. We quickly go to the current portfolio. We have close to about 58 odd stocks. The top 10 holdings about 48 odd percent, and the quality wise, if we see the R1 metrics is slightly higher than the benchmark, tilt towards quality compared to the benchmark. So again, cash flows wise, almost majority of the companies are in that C1 bucket. And valuation wise, because of this higher quality, slightly expensive compared to the benchmark. Yeah, if we go to the portfolio, these are the top 15 names on the left hand side. Most of them are overweights. Some of them may be benchmark weights, but benchmark slightly lower than the benchmark. But most of them tend to have active weights in the positive territory. So wherever we have conviction, we have good exposure there. On the right hand side is the names which are mid and small caps, which are not part of the top 100 names. We do tend to have about 10 to 15% exposure there, where companies we believe are leaders in the category or they are growing faster than the industry. So those are the parameters on which we kind of identify these names and continue to hold them from a longer term perspective. And sector-wise, while financials look like an underweight, but within that, we are positive on the top banks. So top private and PSU banks is something that we are clearly positive on, and select NBFCs. We are a little bit underweight on some mid-sized banks and NBFCs, and some of the non-lending names there. Other than that, the key overweights is on the consumer side, both consumer services and consumer durables, where we believe the growth can be better than FMCG, where the valuations in all consumers are expensive, but at least in consumer durables and services, the growth can be much higher than what the FMCG companies are able to deliver. Besides that, IT, we've been overweight, and the valuations clearly now look attractive after the correction, even if we have to assume that the growth on a higher base for some of these large IT companies will be a little lower in dollar terms, and also they do definitely benefit from the rupee depreciation.
Karthik, one last question before we open it up to the audience. UTI Large Cap Fund is one of the oldest funds in the industry, with nearly 4 decades of history. Over this long journey, markets have gone through multiple cycles and sharp corrections. From a long-term investor's perspective, what have the outcomes been like, especially during the periods of market stress? How has the fund behaved? And when particularly when the markets corrected meaningfully.
If we look at this is clearly the long-term data. So the returns over this long-term period, whether it's lump sum or monthly SIP, this is a theoretical exercise. So based on that, the outperformance versus benchmark has been about close to 1%. So even over a very long period of close to 4 decades, there's been alpha creation, whether a lump sum or SIP basis. The key differentiator for UTI Large Cap has been over the period of its existence that during sharp drawdowns, it has tended to outperform versus the benchmark, here being BSE 100. So on the way down, the down capture or the capital protection is something that has been unique as far as the UTI Large Cap Fund is concerned. So we've highlighted 4 years when there has been sharp correction, and most cases the fund has outperformed the benchmark. And similar, if we look at point to point, we've had 7 instances of 20+% correction in BSE 100, the benchmark for UTI Large Cap, and each of the instance the fund has outperformed the benchmark. So the downside protection is something that has been unique as far as UTI Large Cap is concerned.
Thank you, Karthik. That really ties together the process, portfolio, and the outcomes. Let's now open the floor for questions. Vetri, coming to you, my first question is, at current levels of nearly 38 trillion, how concerned should global markets be about US debt sustainability? And where does India stand relative to global peers on the debt to GDP metric?
Sure. So, honestly, I would say debt to GDP is not a number that you should panic about immediately. It is a number that you should worry about and keep it in your head because it has long-term ramifications. Many people in markets have, lost their patience trying to time a macro instability moment, which is very hard to predict. People predicted it for many years, and Japan still hasn't happened. So I think it is a concern that the US has allowed debt to go up, but it's better to think about the ramifications of what that means for policy rather than worry about will there be a moment of instability. As far as India is concerned, the data is there. Our total debt to GDP in terms of government debt is slightly below 90%. Of course, Government of India is talking about bringing union government debt down to 50% over the next 5 years. So on a consolidated basis, we'll still be closer to about 65-70% debt to GDP. Important to keep in mind that even though we all focus on union government fiscal deficit, presuming that is 4.4%. If you add the states on top of that, it comes closer to almost 6.5, 7%. In terms of run rate of fiscal deficit, therefore, for consolidated India, it is not too different from where the US is in terms of a 7%, federal government deficit, because in the US, the states don't run a deficit. So in terms of run rate, we are actually quite equal. But in terms of directionality, we are doing a lot to bring it down.
Sure, Vetri. My next question is also rooted to you. With corporate earnings improving and consumption poised for recovery, could India become the real Dhurandhar, the dominant force among emerging markets in the coming year?
Well, it's hard to say about the coming year. I think of this as a journey over many years where India will have and present investors with the opportunity to compound. But just because there is a 20-year opportunity does not mean that every year will go good. So I don't look at it from a one-year perspective. We've already talked about the UTI Equity Valuation Index. It's in the fair value zone. So no reason for one to feel either super excited or super bearish. I would say stick to your asset allocation framework, stick to your long-term financial goals and invest based on that. If some other market does well in a one-year basis, let it do well. That should not make us unhappy that some market did better than us.
Sure. Karthik, coming to you. In an increasingly efficient large cap universe, where do you believe sustainable alpha can be generated? Through sector allocation, stock selection, earnings upgrade, or behavioral mispricing?
I think it's a little bit of all that you mentioned. Clearly, the focus has to be on the stock picking within the 100 companies there, which are well researched. There is always mispricing in the short term. So for a long-term investor, that could clearly be an advantage. So that is definitely one area where we would kind of look to create alpha. The other focus is, as we mentioned, I mean, even from a UTI large cap perspective, have close to 10+% of exposure to mid and small cap companies. These could be companies which are leaders in their segment, or they're growing faster, or they are likely to be part of the large cap universe in the subsequent 2-3 years. So trying to identify them early on is another source where we could clearly kind of create alpha. And obviously, when you're picking the right stocks, it also the corollary is that you try to avoid the wealth eroders.
Sure. Karthik, next question is again for you. Many large cap companies derive a significant share of revenues globally. In the current environment of geopolitical uncertainty and growth concern, does this exposure pose a risk or provide diversification benefits?
I think it clearly provides diversification benefits. I mean, we've seen that the rupee generally tends to depreciate versus the dollar on an overall basis. And to that extent, that rupee depreciation clearly helps. And many of these companies who have international business have been in the business for many years and have created relationships and the network there. So they are well established, and to that extent, better poised clearly. So we've seen heightened kind of uncertainty in the last few years. Despite that, many of these companies have been able to kind of deliver stable business performance.
Sure. Thank you, Karthik. In the interest of time, I will take just two more questions. Betty, this question is for you, and this is one of the most sought questions. Gold and silver ETFs witnessed record inflows in January as well, despite price volatility. How do you evaluate these precious metals' relative appeal versus equities at this stage of cycle?
Well, I mean, simple answer to that is unattractive. I think I wrote about this in December commentary as well, that, historically we liked gold. We talked a lot about this in 2022 because we thought, there would be a flow of money going into gold. But in the recent months, it's trading now like a momentum asset. The reason to buy gold is because of its strategic value, because of its hedge against inflation, and because it's a hedge against financial market dislocation. When it starts trading on the basis of momentum, without any underlying logic, then I would tend to worry about it. So in December, I said it's now trading like a momentum asset, and nothing has happened to change my view. In fact, the intense volatility that it has demonstrated in the last 45 days is a reflection of the fact that it's now trading as a momentum asset, not as a strategic or hedge asset. So I would be, cautious over there.
Sonal, you're on mute.
Oh, thanks. Is rising index concentration a structural market feature going forward, or could mean reversion drive broader participation within large cap universe? For you, Karthik.
Sorry, if you could repeat, I missed the first part.
No problem. Is rising index concentration a structural market feature going forward, or could mean reversion drive broader participation within the large cap universe?
Actually, we've seen a little bit of reverse in the last few years. And FY20 end, we clearly saw the top 10 were highly concentrated. And subsequent to that, we've clearly seen that there is broader market participation even within the large caps, and clearly the mid and small caps also. So it's been a reverse. It's been broadening in the last few years. So there is always cycles here as well. I mean, few years we do have kind of broadening when the overall market is doing well and the businesses, all the businesses are doing well. As we speak today, the balance sheets of most of the corporate banks is squeaky clean, and to that extent, most of them have done well. The overall corporate profit margins have come close to all-time highs. So there has been kind of broadening that we have seen. If at all, there could be chances that we would again go back to some mean reversion. But there is a cycle which keeps happening.
Sure. Thank you, Betri, and thank you, Karthik, for those valuable insights. If I were to summarize today's discussion, the global environment remains evolving with tighter fiscal conditions and policy constraints. India continues to benefit from structural tailwinds, including trade developments and sustained capex. Valuations call for discipline and asset allocation awareness. And in this context, quality large caps with strong competitive advantage can provide stability and long-term compounding potential. Markets will always go through cycles, but disciplined investing and focusing on resilient businesses remain key to wealth creation. So thank you everyone for joining us today and for your engaging participation. We truly appreciate your time and look forward to continuing this conversation with you in the next month's webinar. Until then, stay invested and stay disciplined. Good evening and thank you once again.
Thank you.
Thank you. Thank you, everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.